Foord was founded on and is grounded in the principles of investment stewardship. So much so, in fact, that one of the determining factors in our founder's decision to set up the firm was his belief that competing investment houses at the time were overcharging their clients for the level of investment services they were providing. That ethical mindset has shaped not only how we manage the firm and look after our clients, but also, not surprisingly, how we invest. Though the term ESG isn't new, it wasn't coined until Foord has been managing assets for over 2 decades. The concepts, however, predate the terminology. A confluence of events, including the COVID-19 pandemic, has accelerated an already evident trend of investors' desire to not only invest for returns, but invest for good. Across asset classes, assets managed under an ESG banner total $35 trillion, up threefold from 6 years ago, and are projected to eclipse $50 trillion within the next 3 years. Interestingly, importantly, and most of all unfortunately, however, many investment firms or strategies claiming to offer investors an ESG-focused product are falling far short of this goal. In fact, some studies indicate that upwards of 70% of funds nominally containing ESG in the name or description fall far short of or are misaligned completely with targets outlined in the Paris Climate Accords. While potentially disheartening at first glance, this shouldn't come as a surprise, given the lack of investing and reporting standards around the topic. As an example, there are no fewer than 160 ESG ratings firms, each with their own methodology and rationale, and not all transparent. How do we at Foord manage this opacity, and how should investors navigate this space going forward? First, at Foord we don't rely blindly on outside ratings agencies. The divergence, lack of consistency in these ratings fails to offer us the comfort on which we would need to use them as an input to our decision-making. While companies have significantly increased their disclosures around ESG concerns, the lack of standardization makes blind reliance on the data or cross-company comparisons difficult and unreasonable. At present, the best, if not only, way for investors to gain comfort in the ESG qualifications of individual corporates or investment managers is to do the fundamental bottoms-up work required. Luckily, at Foord, engaged and thorough discussions with firm management is core to our investment philosophy, an integral part of our investment process and what we've been doing for decades. While taking an exclusionary approach for some items, such as the use of child labor in manufacturing processes, which would clearly be a non-starter for us regardless of return opportunity, other items require a more pragmatic approach. For example, is it sensible to prohibit investment in all large energy companies? Or is it more sensible to engage with and understand each firm individually, investing in those that are not only making strides to reduce current emissions, but also using their cash flows to invest in technologies required to eliminate the need for carbon-producing energy emissions altogether? We believe it's the latter. Finally, we're encouraged by the actions taken by forward-thinking regulators, including the Monetary Authority of Singapore, where we manage our global products, to standardize reporting requirements for both companies and asset managers. Whether evaluating a company for investment or a fund manager who purports to be ESG-focused, there is no substitute for fundamental research and bottom-up due diligence.